Weatherproofing anything so that it isn't subject to storm damage or even destruction, it always sounds like a good idea, but it turns out to be tougher than you might think. Thanks for joining our webinar today. As promised, today's conversation is designed to share with you our strategy for weatherproofing your wealth. We'll focus on a strategy and approach that we have developed over many years and used with thousands of clients to secure their financial goals, as well as providing peace of mind. My name is Kent Kramer, and I'm the Chief Investment Officer at Foster Group. We've been around since 1989, and our team of now over 90 people here in West Des Moines, Iowa, and in Omaha, Nebraska, serve individuals and institutions with comprehensive planning that includes goal-based, fully customized, and personalized investment management. Okay, that's it for the commercial. Let's dive in. My wife and I grew up in Iowa, where there are tornadoes and floods. We lived for a while in Southern California, where there are earthquakes and wildfires. We were there in 1989 when a 6.9 magnitude earthquake postponed Game 3 of the World Series between the San Francisco Giants and the Oakland A's, making Candlestick Park unsafe and causing roads and bridges to collapse. Then we moved to North Carolina, and were there when Hurricane Fran made its way 2 hours inland to Raleigh, where it did over $5 billion in property damage. Our next-door neighbor, they had a 50-foot lodgepole pine cut their kitchen in half, falling through the attic and into the exterior walls. For the last 25 years, we've been back in Iowa and again paying attention to tornadoes, torrential rain, and flooding. In July of 2018, if you might remember the 32 tornadoes that spun up near Marshalltown and Pella, it seems to us you can't really escape the possibility of storms in your area, so you prepare the best you can, not knowing for sure when the next storm may arrive. In all of these areas, building practices and materials continue to be developed to mitigate the damage when, not if, the next storm arrives. It's not just weather that causes storm damage. There are economic tornadoes and earthquakes as well. Stock market risks include extended bear markets where most companies and investors, they see their stock valuations fall in value by 20% to 30% or more and then remain at depressed price levels for months and even years. Historically, these kinds of market storms are associated with inflation, deflation, unwise government policies, war, global pandemics, and the like. There was the lending and real estate sinkhole that led to the great financial crisis of 2007 to 2009. There was also the large-scale, overly optimistic speculative buying of internet-related stocks, which bid their prices up to such high levels that they ultimately could not be sustained and crashed back to earth in the dot-com era of 1999 to 2001. In the past 65 years, the U.S. has seen 8 recessions and 11 bear markets. Since 1942, the average bear market lasted just over 11 months with an average decline of just over 31%. Of the larger modern declines and recoveries, the dot-com bubble bursting saw a 51% drop in U.S. stock market prices from peak to trough. The U.S. stock market then took 82 months to fully recover, only to fall again during the great financial crisis. During the GFC, the U.S. market began to decline again in October of 2007 and kept falling through March of 2009, ultimately shedding 58% of its market value. It then took 64 months to fully recover. This combination of the dot-com bust and the GFC resulted in a 10-year period of negative total return, down almost 16% for the U.S. stock market as represented by the S&P 500. This came to be known in market history as the lost decade, 2 storms that combined to cost investors for over 10 years. We tell our kids stories to illustrate the importance of preparing for potentially damaging and life-threatening events. The story of the 3 little pigs and the big bad wolf is one. Are you going to build foolishly with straw or sticks, or will you be the wise little pig and build with bricks to withstand the huffing and puffing? Even our Sunday school teachers and pastors remind us that Jesus, the master teacher, counseled listeners to build their houses on the rock and not the sand, so that when the rains come and the winds blow, the house that is our life may remain standing. We're not predicting when or why the next economic and market storm will occur, just that there will be more of them in the future. The question is, what do we do to prepare? Weatherproofing your wealth is about risk management. Avoiding catastrophic, unrecoverable losses should be the number one concern of any comprehensive financial plan. It's impossible to completely avoid exposure to risks and uncertainty. Matter of fact, one of Foster Group's 5 key investment principles is to embrace uncertainty as both a given and an opportunity. But if the range of negative uncertainties are not adequately planned for, the risk of experiencing an unrecoverable loss, well, it just increases. Something called risk mitigation frameworks have been developed for all sorts of uses: business, data and power networks, even war planning. When considering different circumstances, a risk mitigation framework, well, it clearly identifies the risks, assesses the likelihood and impact of those potential risks, implements risk mitigation strategies, and then continuously monitors both the risk environment and the efficacy of the measures that have already been put in place. Financial plans and subsequent portfolio strategies are examples, or should be anyway, of risk mitigation frameworks that anticipate and prepare to address the kinds of risks that could threaten our financial independence and personal goals. When addressing these risks, we have a few options. The most common are transferring the risk, or avoiding the risk, or in some cases, we may choose to actually accept or retain the risk. How do we choose among these? We don't have to think too hard to generate a list of personal risks to address. Health risks, including disabling injury or illness, long-term chronic illnesses with expensive treatments, premature death and loss of income for survivors. Even longevity, living longer than we ever thought possible, is a health risk if we don't plan for a long life, potentially much longer than our parents and grandparents. Home and property damage or destruction due to storm, fire, and earthquake. The potential for catastrophic loss is there, but depending on where you live, the probability may be higher or lower. Personal liability. If you accidentally cause an injury in a car accident or someone is injured on your property, you could be potentially held liable for lifestyle-altering amounts. These kinds of risks are often handled with insurance contracts. The risks are real and potentially catastrophic, but because they don't happen to everyone and they don't happen often, insurance companies are able to pool many people together and issue policies we can buy that transfer the risk from us to the insurance company. In the case of house fires, the U.S. Fire Administration estimated that less than 1% of homeowners experience any reportable home fire damage in a given year. By putting together thousands of homeowners, insurance companies collect premiums for a fraction of the value of all the homes insured because less than 1% are going to have a claim in a given year. Risk transfer, insuring certain risks, is an important and relatively low-cost way and part of a good wealth weatherproofing financial plan. Another risk mitigation strategy is just to avoid the risk. If you don't want to run the risk of being in a plane crash, well, you don't get on a plane. Investors can effectively avoid stock market risk by keeping some or all their investable assets in FDIC-insured deposit accounts or short-term U.S. Treasury bills. 30-day U.S. T-bills are referred to as a risk-free asset and used as the comparison when evaluating the risk and return of other available investment assets. Insured bank deposits and T-bills are not directly subject to stock market risk. However, cash assets like these don't insulate an investor from inflation risk, and they also have an opportunity cost. Their returns have been much lower than stocks, for instance. I mentioned earlier the regular and very negative market conditions surrounding bear markets. In isolation, stories like the dot-com bubble and the great financial crisis, well, they could make us think, I'll just avoid that risk by staying out of the stock market altogether. But if we widen our view a bit and look at stocks other than only U.S. large companies, we see that global diversification as a risk management strategy would have helped even in that otherwise lost decade by providing positive returns. Even long-term investors in all U.S. stock portfolios, including those who began investing at the worst possible moment in August of 2000, but who stayed invested through the dot-com and GFC eras and beyond that, had the opportunity to experience very positive annual returns. Over the last 45 years, stocks inside and outside the U.S. have been the clear winners when it comes to creating long-term returns, the kinds of returns that fund retirements and long-term financial goals. Now, in our view, most investors would be wise to accept the risks of stock market investing, though likely not with all of their investment portfolio. But to accept that market risk, we need a risk management framework for our portfolios and for our financial plans. And that is what weatherproofing your wealth is really all about. A framework that even with the types of risks that are out there, the kinds of bad times we've experienced in the past, It allows us to design plans and portfolios that are well prepared and equipped to manage those risks, even though we don't know when they may occur or what will be the severity of the next potential economic storm. So, here's the question we need to answer. How should I invest my portfolio? How do we accept the risk of stock market volatility and not risk financial destruction? How do we keep our investments safe, but also growing enough to meet my goals over the course of a lifetime? Well, one answer to this basic portfolio management conundrum can be found in a risk mitigation framework that combines assets that avoid risk with other assets where risk is accepted, arguably necessary even, to balance the investor's need for reliable near-term income while also creating long-term growth. The idea is to provide sufficient income and assets to meet the many goals specified in your comprehensive plan and in the time frames that you desire. At Foster Group, we call our risk mitigation framework for portfolios the lifeboat. Our first of 5 investment principles advises, construct portfolios based on investor plans. This first principle assumes that you have or will do the hard work of constructing a comprehensive plan. Within that plan, you'll set goals and time frames. You'll identify risks and come up with a framework to manage them. Some, as we mentioned earlier, you'll decide to transfer via insurance. But until we understand your specific goals, time frames, and cash flow needs, we simply can't design a good portfolio for you. A 25-year-old's portfolio likely will look nothing like a couple approaching retirement, and certainly both will differ from a charitable foundation's endowment. Let's start with the foundation of smart, goal-informed investing, understanding your cash flows as estimated and projected in your comprehensive lifetime financial plan. Think of every dollar in your life as moving in one of 3 directions. Money comes in through wages, investments, or gifts. Money goes out through spending on lifestyle, taxes, and giving. And money waits its turn when we save and invest for future use. This framework of receiving, releasing, and deferring, combined with your balance sheet of assets and liabilities, well, that creates the blueprint for your investment strategy. Asset allocation is simply your mix of stocks, bonds, and cash. You've probably heard of a 60-40 portfolio, meaning 60% in stocks for growth and 40% in bonds for stability. Here's why this matters so much. Most research shows that this single allocation decision will determine most of your investment results, including overall return as well as risk and volatility. In the big picture, it's not about picking the perfect stock or timing the market. It's about getting this fundamental mix, this asset allocation question, right. Now, here's the encouraging news. There's no single perfect allocation or portfolio. Many different allocations can successfully help you reach your goals. Our job is finding the range that works for your unique situation, balancing the growth you need with the stability you require. And this brings us to another key concept in portfolio construction and in our risk management framework, asset liability matching. It's a fancy term for a simple idea. You match your investments to when you'll need the money. And you do this in large part because risk and return, they are related. Higher returning assets historically have been far more volatile and unpredictable from month to month and year to year. From an asset liability matching point of view, it is safer to fund near-term liabilities with low volatility, stable assets so that when you need $5,000 for next month's expenses, you can be almost certain that the money will be there in the amount you need and on the day you need it. Here's an example of that asset liability matching idea using saving for college. It's September of 2025, and let's say you're sending a child to college as a freshman in 12 months. You will need the first tuition payment in August of 2026. You've planned to contribute $20,000 for tuition, room, and board. Now, hopefully, you've been accumulating some savings and investments for a number of years towards that goal. Where or in what kind of investment should you hold that first $20,000 due next August? $20,000 is the liability, the cash flow out. Perhaps you've been using a 529 plan to save. It's fantastic, very smart. The investments in that plan are the assets. You have the choice of investing in stocks, bonds, or cash inside the 529 plan. If you want to be sure you have no less than $20,000 for next fall, the asset you choose needs to be one you can count on, not declining in value between now and next August. From a risk mitigation framework based on asset liability matching, that rules out stocks. Why? Well, because as we've seen, even a diversified portfolio of stocks can lose 20, 30, 40% or more in 12 months, potentially reducing that 20,000 you have now to only 15,000 or less next August. Ouch. Better to put that money in a money market or high yield savings account and avoid the risk of an untimely and potentially severe decline. Now, hopefully, you can see the logic. If the liability you have is a near-term one, like college tuition in 12 months, a stable, though low-returning asset is better matched to the liability and therefore preferable to stocks or even bonds, which both, by the way, can experience declines in value lasting more than 1 year. Let's apply this to a long-term retirement portfolio with some years to accumulate, meaning it can be added to through savings and grow with market returns before being needed to supply many years of retirement income, which again are the future liabilities. For simplicity, we'll use three kinds of assets: stocks, intermediate bonds, and cash in the form of money market savings. These three assets will be used to meet an annual income need, which is the only liability of this portfolio in our example. Now here's a story that illustrates the idea. Sam and Helen are both 50 years old and have already saved $500,000 for retirement. Their financial plan assumes that they will add $40,000 every year until they both retire at age 65. That's another $600,000 over the next 15 years of savings. At age 65, they'll need $65,000 a year from their portfolio to maintain their lifestyle. Here's the investment challenge. If they avoid stock market risk and get no investment growth above the rate of inflation between now and retirement, spending an inflation-adjusted $65,000 a year will drain their portfolio by age 80. So avoiding risk altogether is not going to really meet their long-term goals. But with a portfolio return of just 3% above inflation, not only would they fund their entire planned 30-year retirement, they'll potentially have an extra almost $1 million for their heirs, which also means they have a cushion for unexpected expenses and storms that may come along. How can they achieve that 3% real return? Well, history gives us a guide, though not a guarantee. Historically, global stocks, even with all their storms and bear markets, have returned about 6% above inflation over the long term. Bonds have returned about 1% above inflation. Cash has roughly kept pace with inflation. So a portfolio with 40% in stocks and 60% in bonds would historically have delivered that needed 3% real return. In fact, any diversified portfolio of stocks, bonds, and cash with at least 40% invested in stocks has historically met this target over 20-year periods. And just a quick note here. For the stock allocation of the portfolio, we recommend a highly diversified global stock portfolio. This is not only for return, but also as a risk management approach so that one country, company, or sector of the economy cannot do significant damage to the portfolio. So step one in our asset liability matched portfolio is to make sure we allocate at least 40% of the portfolio to a diversified global stock portfolio for growth. And you can see that in our graph, which is a picture of the portfolio's asset allocation. The light blue at the bottom is the required amount of stock investment for Sam and Helen. Now, you might remember that early on I said that avoiding catastrophic, unrecoverable losses was the number one priority of any comprehensive financial plan. And I've given you a few examples of stock market downturns earlier, the dot-com bubble, the great financial crisis. Over the last 100 years, researchers have found that the global stock market, so not just the U.S., but the combined world equity market, has experienced downturns lasting as long as 7 years in the worst historical case. Think about that for a minute. 7 years of watching your portfolio decline and waiting for it to get back to break even. Following the 2008 financial crisis, U.S. stocks took 4.5 years just to recover to their previous peak. That drawdown period lasted from October of 2007 to March of 2012. So this part of the portfolio building process is why we call our risk management framework the lifeboat. Bonds and even more so money markets are more stable from year to year and holding their value than stocks. Our framework uses these assets to build your lifeboat, a kind of storm shelter for when stock market storms blow in. What we want to avoid is selling stocks while they're in deep and long drawdowns, bear markets. Successful investing, after all, is buying low and selling high. Without a good lifeboat of assets, we might have to sell low to meet our ongoing lifestyle needs and goals. Now, here's how to effectively build your lifeboat. For any portfolio that will have distributions coming from it in the next few years, plan on keeping the first 1 to 2 years of expenses in cash, money markets, and savings accounts that won't fluctuate. Then allocate expenses for years 3 and 4 to short-term bonds having maturities under 2 years. Finally, allocate dollars representing expenses for years 5, 6, 7, and 8 to intermediate bonds. These intermediate bonds offer slightly higher returns while still providing diversification from stock market risk, and that's measured by how many years an asset could stay underwater. We build an 8-year lifeboat because of that worst historical case where global stocks took 7 years to decline and then fully recover. That's the catastrophe we want to protect against, even as we accept stock market risk with some of our assets. For Sam and Helen, this means building up an inflation-adjusted $520,000 in lifeboat assets by retirement, enough to cover 8 years of their $65,000 annual expenses. They don't need all those lifeboat assets fully funded today at age 50, but they'll need to gradually build toward that number as retirement approaches so that they'll have a full set of lifeboat assets matched to the foreseeable $520,000 of those liabilities. Sam and Helen need at least $200,000, as we said, 40% of their $500,000 invested in stocks today to meet their minimum growth requirements. But they have flexibility with the remaining $300,000. If market volatility keeps them up at night, they could allocate it all to lifeboat assets today. But if they're comfortable riding out stock market ups and downs, they could put 60% or even 75% of their total portfolio, again, represented by the dark blue area in this graphic, in a globally diversified stock portfolio, potentially achieving higher returns for an early retirement or maybe an increased legacy. The key is finding your comfort zone within the range of workable allocations, all of which fit inside the lifeboat risk management framework. Think of it like a fairway in golf. As long as you stay within the reasonable boundaries, you'll reach your destination. Stray too far in either direction, too conservative or too aggressive, and you risk missing your goals. Each year, Sam and Helen will need to review their plan, reconfirming goals both for future spending as well as reviewing where they are meeting or exceeding their annual savings and investment plans. With the updated plan in view, it is now easy to check the portfolio allocation to ensure it still fits their plan. If they started with a moderate 60-40 allocation, the orange line in the middle of that dark blue fairway, you can see it was projected to stay within the reasonable range, the fairway, over time. So they may not need to make any changes at all. But if they chose a more aggressive all-stock approach near the top of the dark blue fairway, they'd need to gradually shift toward adding bonds and cash as retirement approaches. You can see this in the increasing amount of brown at the top of the graph, representing that growing set of lifeboat assets required. Funding this part of the portfolio can be accomplished with future contributions to investments, as well as rebalancing the portfolio, which would mean selling some stocks and buying bonds or money market funds as necessary. Now, as we wrap up, imagine this scenario. You retired in 2007 with your 8-year lifeboat fully funded. The 2008 Great Financial Crisis hits, and stocks continue to plummet, down 25% and then going down even more. Your retired neighbors are panicking, potentially being forced to sell their stocks at huge losses just to pay their bills. But you? Well, you can be calm. That's not easy, but you have prepared for the storm. You started 2008 with 8 years of projected expenses sitting safely in bonds and cash. By year end, you still have close to another 7 years covered. Very few people are completely unfazed in extreme bear markets, but you can wait patiently for the storm to pass, letting your stocks recover without being forced to sell at the worst possible moment. Again, this type of planning and asset liability risk management framework that operates by thinking in terms of dollars needed from the portfolio rather than just abstract percentages, well, it shows its greatest value in the worst kinds of market periods. We all spend dollars, not percentages. And when you know you have years of expenses covered, actual dollars of assets matched to dollars of planned liabilities, market volatility transforms from a threat to mere background noise. Your lifeboat keeps you afloat while your long-term growth assets, global stocks, have time to recover and then continue their powerful compounding contribution to your future. Long-term investment success is not about beating the market or finding the next hot stock. It's about creating a portfolio that accomplishes your lifetime goals with the highest probability of success and the least amount of stress, especially valuable during economic storms. A well-designed plan enables you to make informed allocation decisions, ensuring that cash is available when you need it, regardless of market conditions. It helps you hold your growth assets through the inevitable downturns while sleeping soundly at night. You have wisely made your plans, and now you can work and live the plan, year in and year out. We've been using this approach for many years with all kinds of investors. Early on, we found that our clients took real comfort and confidence in seeing stable assets matched to their near-term spending goals. I have watched this approach encourage an educated optimism about financial futures. A grounded optimism helps keep anxious uncertainty out of the picture. Thanks for joining us today. If you found this exercise interesting, this is just one of the many ways that we work with our clients. We'd love to have a similar conversation with you. However, in the interest of time today, if you've submitted a question, we'll respond to you via email after the webinar. Again, thanks so much for joining today. We hope it's been helpful, and we look forward to seeing you in the future.